New investors obsess over interest rates. Experienced investors, we obsess over getting deals done. Because here's the truth, chasing the lowest rate might save you $73 a month. But the cost? How about missing out on a great deal that could have made you multiple six figures? And I see this mistake over and over again, especially with newer investors. They spend weeks shopping for the best rate, calling lenders, trying to squeeze out a fraction of a percent. In this video, I'm going to show you exactly why experienced real estate investors don't shop for rates and what we focus on instead. A quick disclaimer, I'm talking specifically about situations where investors are buying 1 to 4 unit investment properties using residential loans, not commercial financing. Commercial loans are a completely different beast, which I'll cover in a future video. And as always, this video is for educational purposes only. It's not financial or investment advice. Always consult with your lender, CPA, or financial advisor before making any decisions. Now let's break down why rate shopping feels logical, but in reality, it holds most investors back. Look, I get it. Rate shopping feels like the smart thing to do. You find a property, you want the lowest interest rate. So you start calling lenders, comparing quotes, and trying to save every fraction of a percent. That makes total sense, especially if you're new. But here's what most new investors don't realize. For conventional residential loans, most rates are essentially the same. We're usually talking about a spread of 0.25% to 0.5% at most. Now let's put real numbers to that. On a $250,000 loan, that difference works out to roughly $876 to $1,752 per year. That's not nothing, but here's the problem. Saving that amount is not worth losing a great deal over. And that's exactly what happens when newbies rate shop. But experienced investors know the real leverage isn't the rate, it's winning deals. And you win deals with speed, certainty, and the ability to close. And that difference is what separates people who talk about investing from people who actually build portfolios. In the next part, I'll show you why experienced investors treat their lender very differently and how the right lender can become one of your biggest competitive advantages. Here's what experienced investors understand, and most new investors don't. Your lender isn't just a vendor. They're a core member of your investing team. Let me show you what that actually looks like in real life. It's Sunday afternoon. You're scrolling through Redfin and you spot a great deal. You text your agent and she tells you it'll be gone by Monday morning. You want to put in an offer right now, but there's the problem. You need a pre-approval letter from your lender to submit your offer. Your big bank lender? Closed. Your discount broker? They're not answering. But your trusted investor-friendly lender? They text you back in 5 minutes. They send the pre-approval and your offer goes in before anyone else's. This is why we always say your lender is an essential team member. An investor-friendly lender, someone who understands what it takes to win in a competitive market, will help you win deals. And this isn't hypothetical. This has happened to us, not once, not twice, multiple times, because our lender helped us get an offer in ahead of anyone else. We've also won deals when the seller didn't just look at price, they looked at the strength of the lender behind the offer. On one deal, the seller's agent called our lender. They liked what they heard, and that confidence helped tip the deal in our favor. And that's why your lender can give you a competitive advantage. But missing out on deals isn't the only cost of rate shopping. In the next part, I'll walk you through the hidden costs most investors don't realize they're paying and why chasing rates can quietly slow you down and kill your momentum. At this point, you can see how missing a deal can cost you a lot more than a slightly higher interest rate. But rate shopping has other hidden costs that most new investors don't even realize they're paying. Let's start with the biggest one, your time. Every time you switch lenders, you're back to square one. You have to resubmit your application, you have to resend dozens of documents, you re-explain your situation. And if you haven't gone through this yet, here's what it actually looks like in practice. You'll get buried in piecemeal requests for documents, another missing bank statement, updated pay stubs, explanations for every deposit over $500. It can be both exhausting and frustrating. Now compare that to working with a lender who already knows you. They already have your tax returns, your W-2s, your personal financial statement, your statement of real estate owned. So instead of starting from scratch, they just ask for a few updated documents to update your file. That's the difference between weeks of delays and a smooth, predictable closing. And speed matters, especially when you're competing for great deals. But the time drain isn't the biggest risk. The bigger issue is underwriting. Most investors don't realize this, but your loan officer isn't the one approving your loan. Behind the scenes, there's a whole separate underwriting team whose job it is to pick apart your file line by line. So you might really like your loan officer, but if the underwriter is inexperienced or overly conservative, your deal can still blow up. When you have an established relationship with a lender and their underwriting team, there are no surprises. You know exactly what to expect. You know their standards, their process, their turnaround times, and that level of predictability wins deals. And this becomes even more important as you scale. This is where lender relationships matter even more. Once you get to your 5th, 6th, or 10th loan, many lenders start getting uncomfortable. Not because it's not allowed, it is. Fannie and Freddie, which are the organizations that back most of the residential loans out there, let you have up to 10 finance properties. The problem is that many lenders just don't know how to work with investors at that level. They look at your debt-to-income ratio and say, sorry, you've got too much debt. But a good investor-friendly lender, one with an experienced underwriter, knows how to properly account for the rental income your properties are generating. They know how to present your financials so the numbers reflect your true income and portfolio performance. That's what allows investors to keep buying while others get turned away. In our own investing journey, we ran into this exact situation. At the time, my wife Leti was working part-time and our debt-to-income ratio was borderline. A traditional lender would have denied the loan. Instead, our investor-friendly lender figured out a way to make it happen. That kind of creative problem solving doesn't happen when you're chasing teaser rates. It happens when you built a relationship with a lender who understands your goals and knows how to get deals done. And that brings us to another important and often overlooked part of this conversation, because sometimes rate shopping doesn't just cost you deals. Sometimes it exposes you to lenders who aren't operating in your best interest. That's what we'll talk about next. We've also seen the dark side of rate shopping. This is where inexperienced investors are most vulnerable, because when you're focused on finding the lowest rate instead of finding a trustworthy lender, it's much easier to overlook how a lender actually operates. And unfortunately, this is where some lenders take advantage. There are 3 common ways this happens. First is with teaser rates. Some lenders advertise an incredibly low rate just to win your business. They may even lose money on that first loan, but that's not generosity, it's strategy. The plan is to lock you in early and then make that money back on future loans by giving you non-competitive rates once you let down your guard. At that point, you're busy, you're invested, and you're far less likely to shop around again. Second is with hidden fees. If you've ever looked at a closing statement and wondered what all those line items are, you know how easy it would be for a lender to add another so-called processing fee. And if you're focused only on the interest rate, you may never notice those fees at all. Third, bait and switch. This one is especially predatory. A lender hooks you in with a low rate early in the process. Then later in the process, after you've already invested time, money, and emotional energy, quietly changes the terms. At that point, starting over feels impossible because it's just a few days to closing. So most investors just accept it. These predatory tactics happen more often than people realize. And unless you've worked with a lender repeatedly or know someone who has, you'll never truly know their ethics or how they operate behind the scenes. That's why building a long-term relationship with your lender matters so much. When you have a relationship with a lender, you're not just another file on their desk. You know how they operate. They know how you do business. And when something goes wrong, because things do go wrong, there's accountability. There's a relationship and a reputation on the line. And they have every incentive to make things right when issues come up. We've experienced this firsthand. A lender we'd worked with for years made a mistake on one of our loans. Instead of hiding it or shifting the blame, they called us immediately and explained what happened. And they also knocked a quarter point off the rate to make it right. That's what trust looks like in practice. They've even waived fees for some of our students when their service fell short. Try getting that level of accountability from a lender you found online after rate shopping for 20 minutes. That's the difference between being just another transaction and being a valued client with a trusted partner. And that brings us to the most important question of all. If rate shopping isn't the strategy experienced investors use, what should you be doing instead? That's exactly what we'll cover next. So here's what I want you to take away from this video. Stop thinking like a shopper looking for the best deal. Start thinking like an investor. Experienced investors don't obsess over squeezing out the lowest possible rate. They focus on building a strong lending relationship that helps them close faster, win competitive deals, and scale with fewer surprises. That starts with choosing your lender once and vetting them the same way you'd vet anyone joining your investment team. Look for investor-friendly lenders who understand how rental income is underwritten, what it takes to scale beyond a few properties, and things like bonus depreciation, 1031 exchanges, and LLC transfers, and what's needed to scale your portfolio. And once you find the right lender, build the relationship. Stick with them. Have them get to know your goals, your portfolio, and your long-term plan. Yes, you might pay a slightly higher rate here and there, but in exchange, you'll close faster, scale with fewer headaches, and beat out other investors when competing over deals. That's a trade experienced investors are happy to make. If this video shifted how you think about shopping for rates for your next investment property, hit that like button and subscribe. And in the comments, I'd love to hear from you. If you've invested before, how has a good lender helped you win a deal or solve a problem? And if you want to learn how to find an investor-friendly lender, analyze deals with confidence, and build a real estate portfolio the right way, book a free strategy call with our team. Thanks for watching, and subscribe for more videos on real estate investing for high-income earners. See you in the next one.